You think Bitcoin is completely decentralized. You think it is untouchable. You believe that because it operates outside the banking system, Wall Street cannot control it. You are wrong. Right now, one single corporate entity holds roughly 45 billion worth of Bitcoin, but they did not buy it all with cash. It is financed by over 16 billion in corporate debt. When you owe Wall Street billions, you are no longer decentralized. You are leverage. Most retail investors do not understand how the modern financial system actually works. They think market manipulation is always illegal. It is not. The system can legally create massive downward pressure on any asset through complex debt structures. Banks do not need to hack the blockchain to crash Bitcoin. They just need to corner the corporations holding it. In the next few minutes, we are going to break down the exact debt loophole institutions use to manipulate crypto prices. We will expose the mechanics of the corporate death spiral. We will look at how short selling creates artificial pressure and how banks use your panic to buy assets at a massive discount. By the end of this, you will understand the critical difference between the asset you hold and the debt used to finance it. Write this down now. Debt is leverage when times are good. It is a leash when times are bad. To understand the trap, you must understand the debt spiral mechanism. Look at history. In the 1980s, entire countries like Mexico fell into brutal debt crises requiring International Monetary Fund interventions. The pattern is always clinical and identical. An entity borrows heavily. It commits to massive fixed payments, but it cannot control the currency of its own debt. This is a recipe for collapse. When an entity enters this structure, financial pressure forces them to sell their most valuable assets just to survive. Today, this exact same psychological and mathematical pressure is applied to corporations holding massive amounts of Bitcoin. They act like leveraged Bitcoin funds disguised as software companies. They raise money by selling stock, issuing convertible bonds, and issuing preferred shares. They take that borrowed capital and pump it directly into the crypto market. They look like geniuses during a bull run, but they have built a house of cards on top of institutional debt. Let us look at the brutal reality of the math. When a company holds 45 billion in Bitcoin but is financed by 16 billion in debt, that debt is not free. It comes with massive interest. In some cases, these companies must pay around 700 million every single year just in interest and dividends. How do they pay it? Their business model only works if their stock trades at a massive premium to the actual value of their assets. It only works if the public remains optimistic. If the stock price stays high, they can issue more shares, raise more cash, and pay the debt. They are paying off old debt by selling new illusions. But what happens when the illusion fades? What happens when the stock price falls below the actual value of the assets? This is where the loophole closes. If the stock falls, the company loses its ability to raise cheap money. Cash reserves begin to run out. The 700 million interest payment is still due. Wall Street does not care about your long-term vision. They want their money. Now, the trap is activated. To pay the obligations, the company is forced to sell its Bitcoin. This is not a choice. It is a legal requirement. When a corporation dumps billions of dollars of Bitcoin onto the open market, it crushes the price. The lower Bitcoin goes, the further the company's stock price falls. Because the stock is crashing, their debt becomes even more expensive to service. So, they must sell even more Bitcoin. This is known clinically as a death spiral. It is a self-feeding loop of financial destruction, entirely engineered by the structure of corporate debt. You might ask why banks would want to trigger this. Why would large hedge funds want to destroy a company? Because in finance, chaos is highly profitable. The theory suggests that large institutions actively benefit when a massive corporate holder is forced to liquidate. If a company must sell billions in Bitcoin immediately to avoid bankruptcy, they cannot do it on a regular public exchange. They must execute what are called block trades. They go to major banks and sell the asset at a steep discount to secure immediate liquidity. The bank buys the Bitcoin at 10% to 20% below the actual market price. The institution profits instantly. They either resell it to their ultra-wealthy clients or they hold it on their own balance sheets. They use the corporation's desperation to steal your equity. And they do not just wait for this to happen. They force it to happen through short selling. Short sellers profit when a stock price falls. Wall Street can target heavily indebted crypto corporations with massive, coordinated short selling campaigns. They push the domino over. Sustained downward pressure on the stock pushes its value below the asset baseline. This prevents the company from securing new equity financing. It artificially chokes off their oxygen supply. This increases the probability of forced Bitcoin sales. This is not a new tactic. This strategy has historical parallels. In the early 2000s, complex financing structures were used to completely collapse companies and strip them of their assets. Wall Street is just applying a 20-year-old playbook to a new digital asset. So what does this mean for the retail investor? It means you must separate the asset from the entity. If this theory is correct, and Wall Street forces a massive corporate liquidation, Bitcoin's price will plummet. Retail investors will panic. They will sell at a loss, believing the asset itself is flawed. That is exactly what the institutions want you to do. But a leveraged corporation failing has absolutely nothing to do with the fundamental protocol of the blockchain. Bitcoin is decentralized. The corporation is highly leveraged. Do not confuse the cage with the bird inside it. If institutions are spending billions to engineer a crash so they can buy the asset at a discount, it means they believe strongly in its long-term value. They are shaking the tree to see who falls out. To survive this, you must adopt a clinical investor mindset. Wealthy individuals do not panic sell during engineered volatility. They understand the mechanics behind the price movements. They read the financial reports of the largest corporate holders. They know exactly when the debt obligations are due. Stop reacting to the screen. You must focus on long-term fundamentals rather than short-term price manipulation. Successful investors are not the ones with perfect predictions. No one has perfect predictions. The winners are the ones who understand market mechanics, who manage their emotional impulses, and who stay ruthlessly patient while the system tries to extract their wealth. The banks have found a loophole. They cannot print Bitcoin, but they can control the people who borrowed their money to buy it. Debt is the ultimate mechanism of control. Do not let corporate leverage dictate your personal financial psychology. Protect your assets. Understand the debt spiral. Study the system. Do not let their leverage destroy your wealth. Subscribe.